Good morning, and welcome to the Q3 BioSyent Inc. results broadcast. My name is Rene Gorham, and I'm the Chairman and CEO of BioSyent. I want to start the presentation just with a quick information disclaimer. Today's presentation is for information purposes and contains forward-looking statements, and the company does not intend to update the presentation if any of the forward-looking statements don't match with actual results in the future. So I want to start today's presentation with a recap of our sales for the quarter ended. So that's the 3 months ended September the 30th. Sales for the quarter reached a little over $3.6 million. And that represented a 56% increase from $2.3 million in 2013. And as you can see on this slide number 4, that represents a 3-year compound annual growth rate of 55%. So the Q3 sales rate was kind of in line with the 3-year compound sales line that we're on right now. So for the 9-month period, our sales came in at a little over $9.1 million. That represented a 62% increase from $5.66 million in 2013. And once again, the year-over-year comparison is in line with the 3-year compound annual growth rate of 63%. On the next slide is a recap of the key growth drivers for the third quarter. So FeraMAX continued its strong performance. Unit sales were up 37% versus Q3 of 13. We shipped repeat orders to a FeraMAX customer in the Middle East, and this was to support a product that was launched, or the product that was launched in the beginning of 2014, and we've now had multiple repeat shipments to that customer. The sales growth line in that market seems to be outperforming what we were able to do in Canada in the early days of that market. Cathogel units were up 108% versus Q3 of 13, and those 3 points really were underlying our strong performance in the third quarter this year. During the quarter itself, we were preparing for the Q4 launch of a new gastrointestinal product. That's a product that we licensed earlier in the year. We are also preparing for the launch of our first of 3 urgent care products that we've licensed. So the first product will be launched in Q1 of 2015. We've been talking and going back and forth with Health Canada about the approval for urgent care product number 2. And I can tell you that we do not anticipate having that product approved this year. And we also have been working on a third urgent care product, all from the same partner. That product was licensed, and the dossier is being prepared to be submitted to Health Canada and will be launched after Health Canada approves it. On the next slide, you can see the performance of the pharmaceutical business. We now can report that we've got 20 consecutive quarters of quarter-over-quarter growth in the pharma business. This dates back to Q3 of 2009. That's now 5 years. We've been able to grow the business every quarter compared to the previous quarter. Over the last 12 months, this represents a quarterly compound growth rate of 14%. And versus a year ago, the pharma business at $3.09 million was up 68% from the Q3 2014 period of $1.84 million. Quick slide on the 9th slide, just recapping the mix of our business. For those who have been following the company for some period of time would know that we have a legacy business in the non-chemical insecticide area for used in agriculture, post-harvest agriculture. And this business for the 9 months ending September 30th represented 9% of the dollar value of our sales. and you can see the trend over the last 5 years as the pharma business has grown. Most of the business or sales of our legacy product would have occurred by the end of September 30th. We usually have a little bit more that trickles in the fourth quarter. So for the end of the year, we expect the legacy business to represent somewhere in the 6 or 7% range of total sales by the end of the year. So on the next slide is a recap of our net income before tax for the 3 months ended September 30th. And you can see that our 3-month profit before tax was $1.35 million. This compared favorably to $809,000 last year, up 67%. And you can see over the last 3 years how this has sharply climbed off a base in 2011 of about $240,000 for the quarter. For the 9 months, on the next slide, similar trend line, 3-year compound annual growth rate of 109% on net income before tax. So in the 9 months ending September 30th of 2014, that was $3.26 million. Up 78% from $1.8 million in the year ago period. On an after-tax basis for the quarter, for the 3 months ended September 30th, our net income was just over $1 million, and this was a 64% increase from about $610,000 in Q3 of 2013. Looking back to 2011 and 2012, if you're looking back to do a comparison, keep in mind that we had no tax expense in the third quarter of 2011 or 2012. So 2013 and 2014 are fully comparable on a like-to-like basis, where we have tax expense in both periods. Looking at it on a 9-month basis, so the 9 months ending September 30th, our net income in 2014 reached a little over $2.4 million, 75% increase from $1.37 million in 2013. And once again, same comments about tax in 2011 and 2012, there being no tax expense in 11 or 12. So once we get into the 2014 versus 13 comparison, we are talking like to like, fully taxed in those periods. We pay. I think we have a tax rate of around 26.5%. So on the next slide is a snapshot of our balance sheet. Really, the key numbers to focus on is our ability to turn our growth in pre-tax and after-tax income into cash, and we've grown our cash and cash equivalents to just under $6.5 million as at September 30th, up from $4.4 million on December 31st of 2013. The company continues to be debt-free. We have no long or short-term debt. We have an operating line of credit in place with the Royal Bank of Canada. Today, that gives us access to an extra $500,000. It's been in place, I believe, 3 or 4 years, and we have as yet not used a nickel of that operating line of credit. On the next slide, I'd just like to highlight our disciplined management approach to expenses in relation to our sales increase. So in total for the 9 months ending September 30th, our operating expenses were just under $3.9 million. That represented a 48% increase to the 2013 9-month period of a little over $2.6 million. But you can see that lagged our revenue increase of 62% for that period of time. But importantly, take a look at the changes in spend on selling and marketing versus general and administration. So selling and marketing was more in line with our revenue increase, 58% versus year ago, as we continue to invest in our growth brands, our launch brands, and in preparing for launch of new products. And our general and administration spend, which grew only 37% in comparison to a 62% increase in sales. So once again, underscores management's approach to ensuring that the ratio of increase in our OPEX is in line with our sales increase, so that we're step-by-step growing a profitable business. On the next slide is a recap of our earnings per share. It's mostly shows you the calculation of the EPS. In the third quarter of 2014, we earned 7 cents a share fully diluted, and that represents an increase of 75% versus 4 cents a share in Q3 of 2013. And now looking back on a trailing 12-month basis, we have 21 cents TTM fully diluted of EPS. So sorry for the acronyms, but it's 21 cents a share of earnings over the last 12 months. So this year, we have an EPS growth that is quarter versus previous year quarter in every quarter of 2014. On the next slide is a recap of our product life cycle. For those that have been following the company for some time, it's a graphic we use to just explain where our products are in their life cycle. We have a similar representation in our MD&A and our annual report, and so you should feel free to go back and take a look and see how this graphic has changed over time. Importantly, on the top in the green swath, you see the various stages from in-licensing through maturity. We consider a product to be mature if it grows at less than 20% year over year. So we have no products that we consider to be mature either for this year's performance or now next year's performance. We are in the midst of our 2015 planning process, actually well into it, and we've got some visibility now into how we expect those brands to perform next year, and we don't expect to have any products that would fall into the mature category of less than 20% growth. So we've got two that are in the growth stage, Pharmax 150 and Cathogel Jelly 2%, both growth products. We've got two launch products, Repagyne and Pharmax Powder. We consider a product to be in launch phase in the first 8 quarters, so the first 2 years after launch, presence in the market. And then we've got two products in the pre-launch phase. One, the gastrointestinal product that I referred to earlier, planned and well underway for launch this quarter. And then urgent care product number 1, planned for launch in Q1 of 2015. We've got the one urgent care product number 2, which is still at Health Canada for approval, and we're preparing urgent care product number 3 for filing with Health Canada. I'd like to thank you all for your interest in our company and your support. And just wanted to, on the last slide, point out to some additional resources if you want to dig a little bit deeper into our story. So BioSyent.com for corporate information. It's also a good source of financial information, as we've got historical, quarterly, and annual financial reports, and obviously press releases and whatnot going back for some period of time. You can also get financial disclosure at SEDAR.com. That is where Canadian filers report. We've also got information at TMX Money. I find that is often the best source of kind of up-to-date financial reporting and per share data and trading data if you look at consolidated trading data there. And then obviously our product websites at Pharmax.com, Cathogel.ca, and Repagyne.ca. Once again, thank you very much, and I look forward to reporting our continued progress in the months to come.